Morning, everyone. Can I just get a thumbs up from my co-presenters that you can hear me? Yeah, good. Thank you. Good morning, everyone, and welcome to this Underinsurance webinar from Zurich Municipal in partnership with Zurich Resilience Solutions. I'm Alex Bedford. I'm only going to talk for a couple of minutes just to intro the webinar, give some context, and let you all know that it is being recorded. Your cameras and your microphones are off as you're joining. But we would ask that if you've got questions, comments, anything you want to raise, that you use the chat or the Q&A function to put those in. We'll go through a presentation, and then Andy and Alistair, who are about to come on and join me, will answer those questions at the end, unless anything burning comes through, and I'll interrupt and try and get you an answer there and then. In terms of the webinar today, this is the second in the Zurich Municipal Risk Series. We're talking about underinsurance, and as it said on the first slide, really this is about safeguarding assets and communities so that in the event of a loss, your insurance solution is responding in the best way and in the way that you might expect it to. In terms of the agenda, I'm going to hand over to Alistair MacDonald in a moment, who is our Property Underwriting Performance Manager within ZM, and he's going to talk about the scale of underinsurance that we're seeing and what it means to us as an insurer and in our relations with our customers. Then I'm going to hand over to Andy Patterson, who is the Head of Business Development in our property practice in ZRS. We were hoping to also be joined by our colleague Jack Taylor, but he's having internet problems. So if they get sorted out, he may join. But otherwise, Andy will cover everything you need to know about the reasons for the underinsurance we're seeing and the market trends, as well as at the end actually give you an overview of the sorts of solutions you might want to think about in terms of reducing the risks of the underinsurance that we're going to talk about. So as I say, this is being recorded. At the end of this webinar, we will send out an email with a link to that recording on YouTube, so you can watch it back if you so wish, or share it with colleagues, or just refer to it in the future if you want to watch a bit of it back. Please do put questions in Q&A and in the chat, as I said, and I think that's enough from me, and I will hand over to Alistair.
Thanks, Alex. I'm not sure everyone's going to be saying that by the time my segment's finished. I try to bring a bit too much of my personality to these things. So normally I like interacting with people, but I can't see anyone, so I'm talking to myself today, which feels a bit odd. Morning, everyone. We thought it would be worthwhile setting out the scene a little bit before we even get into talking about what underinsurance is, to sort of remind everyone about the importance of setting the right sum insured to begin with. I think it's fair to say we see from different parts of our sort of customer base that sometimes there's a really good understanding of how to set a sum insured, and sometimes we need to offer assistance, whether it's something like ZRS or whether it's just some of the insight that our underwriters can provide about what to pay attention to. So it's quite a complicated issue, but it doesn't really get enough attention. We're trying to bring more attention to it. Setting the scene, though, what is it that we're trying to understand? We need to ensure that our customers are providing us with the right declared values for their buildings. Why do we need to do that? Because we use them to assess your premium, to calculate your premium. We rate on that as what we call the exposure. What is a declared value? What is it supposed to include? So it's supposed to be a reflection of the cost to reinstate the property as new in the event of a total loss. So what sort of things would be in there? The cost of materials like bricks, concrete, timber, but also things like the cost of labor. So contract price can be a really good indicator. Wages can be a really good indicator, but it's not one or the other. We look at both. We also pay attention to things like consumer inflation as well, because they can interact with things like content sum insured rather than building sum insured. But it's not just the cost of that labor or the cost of those materials. It's also the costs of things like professional fees. What are they? Architects' fees or designers' fees, planning permission costs, or the cost of ensuring compliance with up-to-date building regulations. We also need to make sure there's provision for debris removal. Debris removal is basically, in the event of a total loss, the cost of taking down, demolishing anything that's left of the existing building, the cost of clearing the site. And what you tend to find is, particularly in our market, you might have a block of flats, that's relatively straightforward in terms of clearance costs. You might have a very unique building where you need specialist provision for things like archaeological sifting. So debris removal can be quite a complicated thing to consider when setting an accurate sum insured for your buildings. There can be other things too, depending on the age of the property. They might find asbestos, for example, that might necessitate some sort of specialist removal, which again can be expensive. So you can already see there's a sort of element for materials costs. There's an element for labor costs, professional fees, debris removal. And then the last one, everyone's favorite, is VAT liability. And that's going to vary by the type of building, the status of the land, and your status as an organization. It is very complicated. I'm going to talk through it briefly today to help you understand why it's so complicated. Ultimately, we can't give you guidance on what is the right provision to make, if any. But we can give you a few pointers in our experience of things to look out for and to consider. But you really do need to seek the advice of, to be honest, professional accountant, someone with that specialist financial insight when considering VAT on your sums insured. What it isn't likely to include is land value, and I'm making that distinction now because what we sometimes see from customers is sum insured being provided based on the market value of the property. What do I mean by market value? That's the price of an asset in the marketplace. So it's the price buyers are willing to pay and the price sellers are willing to accept for a property. It's not usually tied to the reinstatement value of a building. And as I sort of just mentioned, it will usually include land holding, not just the building itself. There's another type of sort of value that we're sometimes presented with, particularly for housing and residential risks, which is the rental value of a property. So the rental value might be able to achieve. Again, it's not necessarily a good indicator of the reinstatement cost of a building. It's more of a representation of the investment value of a property based on the return that it can achieve. And the reason that we don't use them, they don't really have any bearing to reinstatement value, which is what we're insuring against. We're making sure that we can cover those costs in the event of a claim. And in reality, market value, it can vary quite widely. In the south of England, you probably find that a market value could quite easily exceed the reinstatement value. In other parts of the country, it's less likely to do that. And then you've also got the complexity, depending on the age of a building, its potential future use, or the condition that it's in. It might be sold at a legal minimum of £1. So market value or rental value aren't really good indicators when we're insuring against the cost of putting the building back up as new. We need to understand those reinstatement costs. If we move on to the next slide. So, and we can move on from this one as well. So the question is, why do we want that? Why do we need that? There's a few things to think about here. Again, I shared at the beginning, we rate on the sum insured that you provide to us. That's the basis of the protection that you're getting from us. If it's not accurate, you might not have enough cover in the event of a claim. Alex made the point right at the beginning. An old colleague of mine used to say the most expensive insurance you're ever going to purchase is the one that doesn't pay out or pay out enough. And I think that's a good adage to keep with you. We've got a really good track record. We don't leave customers in the lurch, but at the same time, it's a contractual relationship as well as a wider relationship. And we need to pay attention to whether sums insured have been set properly, because it ensures that we're charging an adequate premium. But it's not just about premium. It's not just about our contract with you. It's also about, we use this to assess how much capacity that we're offering you. And what I mean by that is, I don't have an unlimited amount of cover, if you like, to give you for each of your buildings. I might have more than one customer with buildings in the same vicinity as one another. I have a finite amount of capacity to offer you because I'm a responsible and solvent insurer. I need to understand whether I have any peaks or accumulations of exposures. And so making sure that the sums insured that you give me are accurate is absolutely key to that assessment. Where we're not confident, we're likely to reflect that at least in the cover that we provide, but we may also reflect it in the rating that we charge. We might have to apply loss limits, or we might remove the protection of average. Average is something which is applied if you were to insure for, say, £50,000, and actually, in the event of a total loss, your building was worth £100,000. Any partial claim would be proportionately reduced, so you wouldn't have the full value of that claim protected. You might have 50% of it protected. So average is a common industry protection, mainly for insurers, but there are sort of enhancements that we can offer you where we're confident in your sums insured. There's actually ways to be average free so that we don't apply average at all, even if you do get it wrong, but you've taken reasonable efforts to set your sums insured correctly. And that's always worth asking us about. In really extreme situations, we might decline to provide cover if we really don't have confidence in those sums insured, but I can't think off the top of my head of a time where we've done that. This is all great in explaining why. What does good look like? Well, let me give you the motivation first in terms of what good looks like. Again, a policy where you don't have to consider something like average or even blanket average. So average proportionately reduce the amount of your claim at a building level if underinsurance is detected. Blanket average, the same consideration applies, but we consider the overall portfolio sum insured rather than just the building level. So as long as the overall portfolio is okay, we don't apply average. But average free, that's the gold standard. And for any customer who's taking reasonable steps, using the right methodology, using suitable surveyors with the right experience to set their sums insured, we can't ask you to do any more. If you've taken those steps and you keep them up to date for indexation in intervening periods, we'll absolutely support you with being average free. We can offer you that. And if that's of interest, you should speak to us about it. It's a very powerful protection. I think that's probably the best way to sort of sum out why we need to understand it, why it's important. It isn't just a pricing thing. There's a lot more around how we offer you cover, the terms that we apply, and there are ways to improve the cover that you might get from us. I think the other thing to bear in mind, and I'll come to this when I talk about the levels of increase that we've seen in recent years. If you increase your sum insured by 100%, you shouldn't expect your premium to go up by 100%. I shouldn't be telling you that. I will tell you that. Really simply, claims is a portion of your premium. Exposure is a part of your premium. So if you increase the exposure part of your premium only, you're not going to see that overall increase pan out at a premium level. You're going to see a proportion of it. So you might find in a situation where it's just an indexation, it's just an inflationary uplift, the insurer won't differentiate. You'll just see that rate of uplift. But if you see a sort of 50 or 100% increase in your sums insured, you shouldn't be expecting to see the same linear rate of increase in your premium. It's worth bearing that in mind. And if you do see it from us, please flag it with myself. I'd be very curious to see why that's happened and look into it for you. If we can go on to the next slide. Everyone's favorite topic, value-added tax. I'm not going to make any jokes about it today. I am going to spend a little bit of time on it though, because it's complicated. I shared it on previous slide. If we go on to the next one, I think it's, well, I'll start on VAT first quickly. Value-added tax, it's a tax on consumption. I won't go into the whole history of it. I think the things that you'll come across with VAT liability, what's a good example? Residential properties, they're exempt from VAT, right? I know you can't interact with me, so I'll answer my own question. No, they're not exempt from VAT. Some types of residential buildings at certain periods of time are what we call zero rated for VAT. So VAT is applied, but it's at a rate of zero. Why? I think it's because the government wants to encourage, various governments have wanted to encourage house building. But it's usually applied in a situation where it's a complete new build. And you've got to consider to yourself, right, well, if I'm reinstating, say, a residential building as new, will it be treated as a new build by the taxman? Ultimately, they're the ones who make the decision on that. I wouldn't like to guess against the current economic outlook that we've got. But even if they did, what happens if you have a sort of 90% partial loss, but you haven't included a provision for VAT? Is that going to be enough? Because you won't have the VAT zero rated likely in that instance. So you've got a complexity already there. You've got more complexity though. Rates of VAT can change. Even if you don't include VAT liability because, for example, you can recover it, there are some items within the component parts of the sum insured that still attract VAT. So things like fences and gates and swimming pools and sports pitches, things like that, which will attract it. And usually professional fees, debris removal will have a VAT element to them as well. So I've seen particularly recently some, I'll stop short of calling it, no, I will. I've seen some bad advice out there shared back with me where people are being told they've insured for VAT to date and then they're being told they don't need to do it for various reasons. It's a really dangerous thing to do unless you have professional input to give you that advice. So I'd always recommend that you speak to a financial advisor about that. Make sure you've considered that properly. Again, that headline, residential new builds are VAT exempt. The language is completely wrong, and it's far more complicated than that.
So can I just jump in a sec? We've had a comment from Tariq about voluntary aided schools needing the DV to include VAT. I don't know if you can see it in the Q&A, just if there's anything to comment on around that.
So to be honest, it will be tied. I can't see the Q&A, unfortunately, but I'll look into that in a second. I don't have the expertise to comment on that. What I would say, one of the examples that I'm about to talk through involves an asset for an education provider, where because of their status, they believed that they wouldn't see VAT applied to a new build, but actually there was an element of fee paying going on, and therefore they didn't have that charitable status that they thought, and therefore they didn't include a VAT provision in good conscience, but actually they should have, and it was a factor when considering the claim. In terms of voluntary aided schools, I don't have the expertise to comment there. I'd need to take that away and look into it for Zurich, so I can come back on it. I'm absolutely happy to come back on that. There's the Q&A, I've just found it. Apologies. Just bringing that up. I think I'm actually seeing Tariq in a little while anyway, so I'll probably pick it up with him when I see him as well. And the last thing I'll say on VAT, again, different rates. You could be zero rated. There are some things that are rated at a reduced rate at 5%. So energy saving products, or, converting buildings, houses or flats, they usually attract a lower rate of VAT, but not a fully zero rate of VAT. Renovating an empty property, home improvements, things like that. It's, again, massively complicated. It's not just the type of asset, it's your status as an organization. It is also the status of the land. Moving on from that, with all that complexity in mind, apologies, we can go back to the other slide. This isn't a massively useful slide because I haven't talked about the type of assets, but the reason why I haven't done that is because these are from real life examples, and I wouldn't talk openly about any individual customers or do anything that's identifiable. But I've chosen to look at sort of some insured movements we've seen after reinstatement costs assessments in the last 3 years. And the reason I've done that, February 2022 is around the time of the Russian invasion of Ukraine, where we first saw a spike in costs. There was a precursor to that in the sort of opening up after COVID, where there was a high level of inflationary pressure coming through. But these sort of numbers, they're not the outliers. I haven't seen many rates of increase post-valuation less than 20%. We've seen some extreme ones above 100%. I see plenty in the region of 40 to 50%, all the way up to 75 or 80%. And it's not a particular type of asset. I've seen increases for bridges. I've seen increases for residential properties and for schools and for unique and listed buildings. I think the most egregious, and not egregious in the sense of the customer didn't do anything wrong, but the most egregious example I ever saw was a building that had been insured for about £300 million, and it increased to £900 million after evaluation. Worse still, the valuer who gave them that assessment gave them a credibility weighting. They gave them a reliability sort of range of plus 40 or minus 60%. Massively complicated, but that was a very unique building. If we can go on to the next slide, the first example, and prompted by Tariq, I sort of touched on it briefly. We had a situation with a customer where it's an educational establishment, and they had a partial loss at their building. Underinsurance was identified, and there were two components. The actual underlying sum insured without provision for VAT was inadequate. But it was worsened because the VAT provision hadn't been included. Now, this customer had done everything right. They'd set their sums insured following insurer guidance, including the insurer prior to coming over to ourselves. The last time they had a valuation done, though, was in 2012, and this was a 2022 loss. And what they found out, they believed in good faith that if they had to put up their building as new because of their status as sort of non-fee paying, they would be zero rated for VAT, and therefore they didn't include it in their sum insured. they actually determined that there was an element of fee paying going on, and therefore they didn't have that status, and therefore they should have included VAT provision. We try to be really sensitive in situations like that. We try to consider whether reasonable steps have been taken to include adequate provision in the sum insured for VAT, but at the same time, the actual underlying wasn't accurate either, because the last time they had something done was in 2012. And again, they hadn't done anything wrong. We see plenty of customers impacted in the same sort of way. No one, in my experience, no one's going out of their way to do anything wrong. It's just a complicated issue that perhaps gets overlooked a bit too much, which is why we're trying to bring focus to it today. If we go on to the next slide, it's just example 2, but it's a prompt for me. This example is a bit more straightforward in the sense of it was a customer where they had been insuring inadvertently for market value rather than reinstatement cost, and they suffered a loss. The asset that they were insuring from a market value basis was insured for about £450,000, but the actual reinstatement cost of the building was closer to £750,000, £800,000. We didn't apply average there, but we had capped cover to the declared value that was provided to us, so they had a shortfall in their claim settlement. And that was actually an asset in the south of England. So that's actually an instance where the market value in some instances might have been higher than the reinstatement cost, but for whatever reason here it wasn't, and they were left with a shortfall in the amount that they could claim for. So it's a good reminder of thinking about not just market cost, making sure you're insuring for reinstatement cost. I think there's another slide to move to. Yes. And I think I might be handing over to Andrew on it, but I'll be coming back in just a moment.
Perfect. Thanks, Alistair. And Alex, so just while Alistair's still there, are there any more questions that would be for Alistair or?
Yep, there's another question come in terms of reinstatement costs. It's coming from Narinda. So in terms of reinstatement cost assessments and revaluations, does ZM accept desktop valuations, given the technology allows for buildings to be viewed virtually on the outside?
Absolutely, that's a really good question. I'm glad someone brought it up nice and early. I'll give you a politician's answer. We're really supportive of technology. We appreciate that sort of on-site assessments have a much higher cost than desktop assessments. We can accept desktop assessments, what we call a sort of square footage assessment. We can accept it, but it tends to be for smaller assets. It tends to be for things like houses, assets that might be below £5 or £10 million, where we sort of push back and try to help our customers, perhaps through some risk management contribution, so funding towards it, is with on-site assessments for unique and listed buildings. I'll come back to that in a moment, but also things like blocks of flats. What we often find with these sort of desktop assessments is they'll look at the square footage based on the number of units, but there might not be adequate provision or any provision made for common parts of the building. So we usually find if the asset's sort of below £5 or £10 million, if it's not uniquely listed or not a block of flats, we should be all right with a desktop assessment. We want to make sure that we're happy with the methodology that's used, the various indices that have been followed, but generally speaking, good track record there, and we will recognize that from a sort of average free position as well. It's the unique and listed buildings, larger block of flats, larger buildings in general, which tend to be more complex, where we'd look for an on-site assessment. Hopefully that answers the question.
Yep, thanks. And there's one more just come in, speaking of unique and listed buildings, from James Meller. So James's question is, what would you say is a reasonable approach to adequately cover VAT costs across a large complex portfolio, where the VAT impacts may vary across different properties or even have different rates in different parts of a single building?
I'm smiling broadly because I haven't spoken to James about this directly, but I know we've had conversations about it for his portfolio. It's a really good question. We often see customers insure on what we call a first loss basis, so they don't insure for VAT across everything with their full sum insured. They sort of work to a first loss basis, so they might have a sort of 15 or a 20 or a 30 million pound or a 50 million pound VAT item in order to achieve some cost savings, so that they have a protection, but they might not need a full protection. I think the best thing to do in situations like that is to be upfront with your insurer, whether it's with us, whether it's someone else, and ask them the question. Being really open, we don't have this as an extension. There's a reason for it, which I'll come back to, but some insurers do have this as an extension. there's what they call a VAT extension. It's common in the real estate market. And what that holds is, again, if you take reasonable steps to include VAT provision in your sum insured, if you get it wrong, you won't be penalised. It's worth talking to your insurer about that. The reason why we're a little bit sceptical of them, particularly recently, is I've seen a few abuses of those extensions, with advice being provided to customers who have insured for VAT to date, taking it out of their sum insured on the advice of an advisor, not a financial advisor. I'm not going to label a broker either, but a sort of insurance advisor, because their potential insurer will give them VAT basically for free. That was something that was stamped out in the real estate market about 5 to 7 years ago. It's some bad practice I've seen very briefly emerge because of the inflationary environment that we've been in for the last sort of 24 months. But it's something that I'd always caution against. Particularly if you've been insuring for VAT to date, my advice would be, if you are concerned about it, talk to your insurer, reflect your understanding in the contractual protection that you've got. Think about first loss items. That would be a really good starting point. But talk to your insurer. That's the best thing to do. And hopefully, James, that's not a politician's answer. I'll happily catch up with you after this.
Thank you. You're getting a thumbs up. Just one quick question before we move on to Andy and your part of the presentation. Just to follow up from Lorinda, how often do we expect valuations to be undertaken?
Good question, really good question. Sort of the average, if you like, across the sector, across the insurance sector, would be every 3 years. In the last 24 months, we've seen some insurance advisors recommending every 12 months. We haven't said that. It really depends on the type of program that you've got and the type of assets that you've got. A residential portfolio, you might be okay with every 5 years. A lot of our customers will do a rolling program, so they'll do sort of 30% or 20%, so 30% over 3 years, 30% a year over 3 years, or they'll do 20% a year over 5 years, and they'll do it on a rolling basis. There are plenty of ways to do it, but again, it's worth talking to your insurer about. But the average would be every 3 years, making sure you're keeping pace with any sort of indexation guidance from your insurer in the intervening periods, the annual renewals.
And sorry, just to jump in there, it's also really important to understand that if there's been any changes to your property, even if an RCA has only been completed, say 6 months ago, if you've had any demolition work or refurbishments or renovations, it's important to get those figures updated then. In some cases, I know underinsurance is a really big problem, but in some cases, if RCAs have been completed, say 15, 20 years ago, and a index linked figure has just been applied year on year after then, what can happen in some cases is that those sort of sums insured will just compound and compound over a period of time. So as much as underinsurance is a big problem, you also don't want to be overinsured.
I'm going to shut up quickly, Alex, but the only thing I'd add to that is sometimes we get blinders on almost, and we focus on the big stuff and not the small stuff. I've shared with our underwriters quite recently sort of smaller but listed buildings, turret structures on bridges and things like that, where they'd sort of been insured for sort of £2-3 million, and we've seen reinstatement valuations coming back. It's sort of I think the highest we saw on that one was about 50 million, but another one was at 40. There's some big swings that we're seeing. It's not just the big stuff that you need to think about.
Excellent. So are we handing to Jack now? No, thank you for joining, Jack. Your issues are over. So Jack Taylor is a senior risk engineer in property practice on the valuation side. So yeah, Jack, Andy, over to you.
Perfect, thank you. Yeah, hi guys. My name is Jack. I work within ZRS and lead the RCA team. I'm just going to be talking to you a little bit about underinsurance and what we can do to mitigate this. 76% of UK buildings are underinsured. On average, buildings are only covered for 63% of the value that they should be, and 10% of small organisations wouldn't survive a £10,000 claim. So just to elaborate on that, some of the most common reasons for underinsurance are incorrect methodologies used, market values used, as Alistair said, lack of understanding of true costs. So just to sort of go back on the desktop valuations can be a really useful tool, but only if they're appropriate to the property type. You have to watch out for sort of certain providers of RCAs, because if they're cheap, they're normally cheap for a reason. It's because they don't have the time within the costs that they charge to sort of have a proper look at the building. We had an example sent to us by, should we call them, an unnamed provider, where they had valued a residential building in Blackheath, and they'd used the most standard average rate for a residential block. But this residential block in particular had London stock brickwork, which you can't sort of buy anymore. If it's the proper stuff, it has to be reclaimed. It had sliding timber sash windows. It had parapets and chimneys to the roof. It had stucco work to the windows and door surrounds. It wasn't your standard residential property, but it had a very standard rate applied to it. So that's the only thing that I'd say watch out for. On the desktop valuations, and it kind of ties into sort of the incorrect methodology used. Not all of the extra overs, should we call them, considered within the true cost of the building. Incorrect data applied as well, so such as costs, like I've just gone through, but also floor areas. Floor areas are the sort of the basis of a good assessment of an RCA. And just as Alistair said, especially on the residential stuff, what you guys might have access to. The net internal areas of a residential part. So you have the floor areas of, say, each residential unit, but those common areas aren't considered within the reinstatement cost. It's super important to get the floor area right, because it will have a significant impact of the declared value overall. And again, just to sort of reiterate, one of the most common reasons we see for underinsurance, whether it's a large gap or a smaller gap, is the total reliance of published data. So that data is really good. It's a really good benchmarking tool. It will give you a good idea of where your property should be, but it isn't a one-size-fits-all approach. A lot of the data that you will find online, again, very good data, but that has a lot of other data and case studies added into it, such as refurbishments and renovations, which aren't quite appropriate for a total rebuild or new build property. Next slide, please, Andy. So just a quick look at the tender price indices. So tender prices continue to ease, although we are expecting a little bit of an uptick in demand in 2025, and the growth of building costs remain benign. So what I'd say with this in particular is it is expected to ease, and you can see from the graph that it's forecasted to ease. But the only thing that I would say is, if you just look at the history of the graph, it hasn't quite eased yet, and it is very, very uncertain. If you haven't had your buildings properly looked at since 2022 or before, I'd really recommend getting them looked at, because it just means from every point onwards you can just be more and more over or underinsured across the portfolio.
Yeah, just on that quickly, if we could go back to the other slide, just for a couple other points to pull out. These looking back, they're actuals, but looking forward, they're forecasts. And we often forecast 6 months in advance, and those forecasts are less reliable at that stage. Other insurers in other markets, they might be doing it sort of a month to 3 months out rather than 6 months out. So there can be a weakness to the forecast. But the other things to sort of remember, it's tied to national trends rather than any sort of regional or very regional ones. It doesn't necessarily distinguish that well between assets. We saw in the last 24 months that residential versus non-residential inflation was massively different. They spiked at different times, and they had different lengths of duration. I think the other thing just to sort of stress here, you're looking both at materials costs there and labor costs, and post 2008 and again post 2016, you can see differences in the way that they were tracking against one another. So it's always worth looking at them together rather than individually. And the last point to pull out, and it's been the last 6 to 9 months, labor costs have been inflationary, probably at about 6 or 7%, whereas materials costs have been deflationary at about -2 or -3%. And so what you've seen is a skew to the average that gets produced. So at one point we were seeing indices sort of tracking, BCI was probably about 1.5 to 2%. It's moving back towards its pre-COVID level of about 3% per year. So it's just worth remembering that, again, national average, the skews that can exist, it varies by asset type. So it's a guide, but you'll know your assets best. You'll have your expertise to help you with that, to make sure that you're looking at the right number. But this is definitely worth paying attention to.
Thank you. Yeah, and then just to sort of reiterate, if your figures are not correct now, then the further we move from this point, the more incorrect they will be going forward. So underinsurance trends. So where do we see as an RCA team where there is the most underinsurance? So all of the above on the screen really is where we see the most underinsurance, and I suppose it just comes down to just to sort of specify on the most common reasons of underinsurance, it's just incorrect methodologies, lack of understanding of the building, and totally inappropriate pricings used. Next slide, please, Andy. So in the event your organisation is underinsured and needs to make a claim, likelihood is you will have to self-fund the repairs. There will be a potential delay in finding funds and the work being completed, and there will certainly be an impact on the customer, employees and the organisation.
Perfect. Thanks, Jack. I think that's over to me now. So just finishing off, just conscious of time. So again, Alistair and Jack have talked through this. I won't spend a lot of time on this slide, but I've certainly seen examples. Alistair's given some examples. We've had some where the client would say to us, potentially they thought the value or declared value was around £1 million. When we've actually looked at it and Jack's used his expertise, it was closer to 11. So there are some real really big highlights and numbers on there. So I think that the two things I would say, Jack's just talked through that graph and Alistair has. And just to reiterate, every time I join the webinar where they look at that graph, it always talks about things leveling out. It hasn't ever done that, and that graph continues to move on and constantly talks about the fact that it level out. But as they both commented, that it's never happened before. The point here about that 10% surviving a claim. So I think one of the roles that I have on my role is very much to help clients like yourself, and I've got a lot of experience about working on risk and protection under insurance. That 10% is really important. So obviously there was a question about doing rolling programs. That is absolutely something that we can help you with. So more and more, Jack and I are seeing people, because of budgets, look to run rolling programs over 2, 3, 4, 5 years. And I think that's really important because we understand budgetary constraints, but it's really, really important at the same time that you do get those correct figures, because if someone doesn't get a desktop, which may only cost £250, and that claim comes in, that's going to have a huge impact, as Jack's just shown. So it is really, really imperative that you make sure you've got those correct figures, because otherwise there's a significant impact, obviously on the property, but obviously on the business, and obviously the end customer as well. So that, to me, is that one of the things to take away from this is just the importance of making sure you do have those correct figures. So just to finish off, the free services or options that we can do to help you. So we can help, obviously, Zurich clients. We can help non-Zurich clients as well. But one of the areas that we will focus on, and Jack will work on specifically. So we can do what we call a health check. It's effectively a horizon scan. So this is a really affordable option for people with large property portfolios. We will be able to look for you across that portfolio and really give you a good understanding of, okay, which are the ones that we feel may need to go and get a boots on the ground approach and have that full assessment. But it's a brilliant cost effective way to get an understanding of where are the potential risks and under or over insurance in the portfolio that you currently have. Obviously, we talked already about desktops, and Alistair answered the question about whether we can accept them. As he talked about, as long as it's under 5-10 million, and it's definitely going to be under that, like the example I gave from the 1 to 11 million. If you need a desktop, absolutely something we can look at and provide for you. And again, that's something where Jack and the team will pick up on that side of things. And finally, Jack gave a really, really good example about where there was underinsurance before. And I think that just reiterates the experience we've got, where when I talk to clients, sometimes often they'll say they're not sure when they last had it done, or it might be a market valuation, or they've used an average kind of rate per square meter. The importance of the work we do is that we will go out and look at the complexities of each of your types of property. So there'll be any type of weird and wonderful elements to the property, and we will look at that in absolute detail. So we'll spend time on the site looking at absolutely every single material and element to that property. The work is done manually, etc., and that's really important. So be able to look at that and then go away, write that report up, and as I think it's either Jack or Alistair mentioned, we'll then be able to tell you, demolition fees, debris removal, professional fees, planning fees, etc., etc. So just to really reiterate, we can absolutely help you when you need it. Again, back to that question, what we always say are the risk engineers, if it's not been done in 3 years, it's definitely advisory. If it's more than 5 years, strongly recommend you do it for the reasons that have been mentioned already. But we can really help you on that rolling program. So if it's something that you want to discuss, absolutely, then let us know. And just before we stop for questions, just final slide. So we've obviously talked about building valuations, top right hand side. There are other areas we can help with as well. So be remiss of me just very, very quickly. So one thing to talk to you about, and I think there's some people on the call that I've already spoken about already. Zurich Insight, we do have a building energy management system. So I know a number of you now, obviously we've talked about budgets and costs. That's something we can help with regards to helping you reduce energy costs. I know a number of you now have sustainability targets. And obviously we talked about risk the whole way. That's a key area. So if that's something that you want to discuss, we can help you with, then please do let us know. So we said we'd be 45 minutes. We've done 43, so that's pretty good timing. So I will just pause now. I think Alex is looking to see if there's any questions. But if you haven't got any questions in, please put them in the chat now, and Alex will ask whoever's relevant for those questions.
Thank you, Alistair, Jack, and Andy, for bringing all your expertise to the call. There's a couple of questions here, Alistair. I know you've answered one.
Oh, you're back, Alex.
Oh, am I back?
Yep.
There's a question in the chat that I think, Alistair, you've kind of responded to, but just for the benefit of everyone else on the call, in case they haven't seen it, Karen asked about providers who might be using the right or correct criteria and indices to help to assist customers in not using suppliers who might not be providing the service that we might, as insurers, might require. Do you want to share your answer on that one?
Absolutely. What we can do afterwards is sort of send out the sort of criteria that we consider, and this is where Jack and Andrew need to close their ears a bit, because we've got ZRS, they're great. We can recognise their valuation service to slightly higher threshold than some other providers. But generally speaking, we're not going to force our customers down a particular route. We appreciate a number of our customers have in-house teams that do this for them. What we can share is the criteria that we look at when considering whether a sum insured provision is adequate. So again, those steps that I went through in terms of reinstatement provision around materials cost, labour cost, but also the methodology that they're using, making sure that the assessor has sort of following RICS, but also has the requisite experience, particularly for unique and listed buildings. I am going to come back to that. As long as those criteria are followed, we are happy to recognise that from a number of providers. And again, you don't need to use one provision over another in order to get an average free protection from us. So we've got something from ZRS which works to quite high limits because we're more confident with their methodology. As long as we've got an understanding, we'll share what it is about the provider that you're using, we should be okay. So we'll share that round after the call. I touched on unique and listed, just expanding on it on a little bit. No longer a customer with us, unfortunately, but they had a unique assets, very unique assets, and it was insured for about £300 million. And we found actually they had a partial loss. It tied to that asset, and a partial loss. They didn't lose the entire thing. They lost part of it, and the repair costs were disproportionate to how much of the asset had been damaged because of the specialist nature of it, because of the materials that needed to be replaced, because of the archaeological sifting that needed to be carried out, and because actually the reinstatement was delayed by interested parties, so heritage groups and things like that. So we often find that actually, particularly with unique and listed buildings, partial losses can be disproportionately expensive to the overall sum insured that we've been given. Worth bearing in mind.
Okay. Is there anything you want to add, Jack or Andy, on that one, or should we move on to the next one?
Yeah, just to sort of quickly add, if you're really not sure, even if you've not used us as your provider, but you sort of are not confident on your sort of current provider's methodology, please share it with us. We're more than happy to take a look at it and give you some friendly advice.
Well, thank you. So next question: when ZM carry out property surveys, do they consider the RCA value and compare it to the actual sum insured and notify the insured if there appears to be an underinsurance risk?
So from our side, I'll just jump in quickly. It depends on how it works. If we're working for you guys, we do have to have the express permission from yourselves to share any sort of facts and figures with the underwriters and with ZM themselves, because we're sort of working solely on your behalf.
So when we have a sort of what I'd sort of so not an RCA survey, not a reinstatement cost assessment, when we have a sort of general property survey, our surveyor is going out to consider different things, so the fire risk, the flood risk, etc. A couple of things to bear in mind: we don't survey all of the buildings that we insure. We have different thresholds depending on what type of building that they are. But where they go out, generally, our survey reports, our surveyors will consider, but it won't be a detailed assessment that they make. They will be looking at it usually from a square footage assessment to see if things are in the right sort of ballpark. And if they think that it doesn't look right, they'll make the underwriter aware, and that's where we can make the customer as well. Say, well, actually, our surveyor's made a comment here. Can you help us understand how your sum insured has been set? Has it been reviewed recently? So our surveys do help us understand that, but we're not doing it on all of the assets that we insure for our customers.
Excellent, thank you. So yeah, it's important, I think, just picking up on Jack's point, reiterate. So Jack and Andy work in a bit of the Zurich business, Zurich Resilience Solutions, which is a separate bit of the business from Zurich Municipal. So yeah, when they're contracting with you as customers directly, you're their customers as well as our customers. So yeah, that it's worth kind of recognizing that difference if there's any concerns around information sharing and things. We've had a couple of comments, one in the chat and then a question about slides or recordings being made available. Yes, we will email all of you and those who registered with a full recording of this webinar after it finishes. We've got a YouTube channel you can see it on. If you then want slides on top of that, if you could email me and I'll get them sent out to you. But the recording will be the main bit, because as you've heard, we want the discussion to be part of your discussions out there as well as just the slides, as they're quite flat. But an interesting point that is made by Lisa in the Q&A around going and using them in discussions with their property manager. I just wondered, Alistair, if you were, in terms of a bit of a call to action from this, that who is it within organisations that we would like our kind of risk and insurance managers to be engaging with on this topic?
There are all sorts within local authorities. They often have an individual or a team with the sort of requisite experience to set sums insured for them, but they tend to use desktop. We're very keen to see that they sort of look at things on site. For larger buildings, they might need to use a third-party provider for that, but it really depends on the organisation. But usually, what I'd say is, if an insurance officer wants to connect us to their team to talk this through, I'm happy to meet with any of them. Our underwriters will happily meet with any of them to help you understand it and to convey it to them and get involved in that discussion. The reason for it, I don't use it as a pun, but not just tied to COVID, but underinsurance is endemic. It is there. It doesn't seem to be getting better. It seems to be getting worse, but our customers are absolutely taking the right steps. So we're constantly keeping it in focus, and we want to be doing more thought leadership on it. We've been talking about buildings today. We haven't talked about, for example, business interruption covers or anything like that. And there's a whole different topic there to consider in terms of the adequacy of your indemnity periods and whether you're insuring for revenue or profit. Not all of you need to do that versus increased cost of working. There other things to consider outside of just your building sum insured adequacy to make sure your program's protecting you in the right way. And perhaps a future discussion is around things like the indemnity period. Particularly after COVID, we've seen a number of customers thinking about the adequacy of their maximum indemnity period. Quite often you'll see a sort of 12 or an 18-month provision. Usually it needs to be 24 to 36 months. We've now seen customers moving out to 48 months. So again, geography is a factor, the type of operation that you've got is a factor, the type of building is a factor. So we're hoping to build on this more generally, but I think in the interim, reach out to me, reach out to our underwriters, will absolutely help you in explaining this to your stakeholders. There are a couple more questions in the chat though that I can see.
You want to take Connie's? Yeah, Connie's questions are doozy.
I know, it's great because I absolutely love terrorism. I'm not, and I'll never beat up on Pool Re because I know them and they're good quality. I'll share a bit of insight. It was Pool Re, I think I mentioned earlier in the presentation, VAT extensions and abuse of them. And when I was in the real estate market last, it was quite commonplace. Insurance advisors would recommend to people, oh no, you don't need to insure for VAT because the insurer's got this VAT extension. And they ignored the part that said you need to take reasonable steps to set a provision for VAT and your sum insured if you need it. Pool Re put a stop to that because they refused to recognise those extensions. And so you had this disparity created whereby the terrorism premium had to be rated on the full sum insured with VAT, whereas what we call the underlying, the bit that the insurer is doing for the other covers, and that didn't necessarily happen. So what that led to was basically those extensions stopped being abused, but it led to a bit of a disparity between terrorism pricing versus the underlying. Connie's asking about something there which is tied to Pool Re. There have been a few changes made to Pool Re. So what Pool Re is a treasury-backed pool to provide for terrorism cover. So we're a member, most insurers are members of that, and they can access reinsurance protection for terrorism risk. That pool's changed a little bit. It's changing from the 1st of April, in fact. The direct answer is, Connie, I'm not aware of anything that's changing at the moment in terms of the requirements of members that will have an impact on VAT, but we are keeping it under review. You can probably appreciate we're moving into a bit of a new world where pricing and sort of acceptance has been set by Pool Re for the longest time, going back to 2003. It's a bit of a sort of watching brief to see what insurers do in reaction to it now that they've got a bit more flexibility about how they set their own pricing. So it could change, but there's nothing I'm aware of with the new structure that would suggest we'll see a change yet. I hope that helps on that one.
Thumbs up, I think,
cool.
On that one. Thank you. So I haven't got any more questions in the chat at the moment. I think before we close, and if there are any burning last minute questions that people want to post, could I just come to all three of you for a bit of a final, as I say, call to action? What would you like to see our customers doing, having heard all this information, in order to try and start to address the underinsurance issues that we're seeing? If I start with you, Alistair.
Nice and simple. I'll keep it to three. Talk to us, engage us. If you'll allow us, we'll happily speak to your stakeholders to help sort of socialize this issue with them. And I use it a lot. The most expensive insurance you're ever going to buy is the one that doesn't pay out or pay out enough. It's worth remembering that. There's no point relying on false economies when it comes to insurance. There really isn't. That's all I'd say.
Thanks. Andy?
I'm glad you went second. I'd have run out if it was third. Yeah, I think the key thing, as Alice said, is just talk to us. So we've got extensive experience of working with clients like yourselves. It's easier for me to talk about Jack than Tim to himself. This is Jack's role full time. His team behind him have incredible experience. So just reach out to us, fully aware about budgets and restrictions, and like we talked about those rolling programs. So let's have a chat with you, and we'll see how we can help you with budgets and priorities and timescales.
Hi guys. Yeah, didn't leave me much room there to sort of make some points. So yeah, just to reiterate what Andy and Alistair said. Yeah, please talk to us. We don't bite. We're very friendly, and we're always eager to help.
I forgot one, Alex. I did forget one. I read on it right at the beginning, and I shouldn't be saying this, but I will. Doesn't matter who your insurer is. If you're seeing a non-inflationary increase with your sum insured, so after evaluation, say your sum insured goes up 100%. If someone comes back to you with a 100% increase in your premium from ZM, talk to me or talk to them. That should not be happening, because again, nice and simple. Part of your premium is claims. That's not changing. Part of your premium is exposure. That is changing. So it's not a linear increase. Really worth remembering. I don't want people going away and thinking, oh gosh, my sum insured goes up 100% and therefore I'm going to see a 100% increase in my premium. That's not the case. At the smaller end, we don't focus as much, but when you get to really big increases, sort of above 25%, talk to us about that. You should not be seeing a linear increase like that. Good to remember that.
Thank you. So thanks to Alistair, Andy and Jack for joining us and sharing their expertise today. As I said right at the beginning and have reiterated, you will get a recording to this webinar, so please feel free to share, rewatch, etc. We want to get the message out there and ask for support where we can offer it to you. Just to flag, the next risk webinar we're going to be holding is going to be on the 31st of March. It's going to be on motor and fleet safety, so another hot topic for you all to join us for. So I hope to see you there. I will end the meeting. Have a great rest of your Friday and weekend, and we will speak to you soon. Thank you.